So it's definitely a loaded topic, right? You have all kinds of different professionals from different perspectives and different standpoints on this topic for sure. I'll tell you what I think he means. So there's term and permanent life insurance. Whole life insurance is what he's talking about when he says permanent. There's a few other types of products there, but term life insurance is going to be the least expensive way to buy a death benefit for a period of time. So there's one concept that's called buy term, invest the difference. This is the idea that you buy the least expensive possible life insurance policy to make sure if you die prematurely that there's money that pays out to your family so they're protected, because your income needs to be replaced, especially if you're the breadwinner. But the concept of buy term, invest the difference is you find the price of the most expensive kind of life insurance, which is whole life, and let's just say that was $100 a month. And you could buy a term policy for a fraction of that, let's say $20 per month. So the concept is still put out $100 every month, but put $20 to rent the life insurance per se for the 20 or 30 year term, and then invest the $80 every month. And by the time you get to the ending of the term of the life insurance policy, your payments that you invested should have grown to be equal or greater than the life insurance policy. So now you don't need the life insurance anymore because you've saved enough of your own money to fill that gap. Then on the flip side, you've got a permanent life insurance where it won't ever end. You'll pay for it essentially until you pass away one day. And that kind of policy costs more money. And it does build a pot of cash value, but the cash value that it's building may or may not grow at the same pace as an outside investment because of the fact that there is cost of insurance inside. And so some of this extra money that you're paying that builds in the cash value is getting used to keep the policy alive. But these kind of policies allow you to like borrow money from them, or even take withdrawals later, or if you ever cancel it in the future, you get some of that money back. But most important factor is that the insurance is permanent, so you'll never outlive it. Why does he say that it's a middle class situation? Is because the middle class basically has to work their entire life to be able to afford their life. And when you buy a whole life policy, you're going to pay for that for your whole life, right? And so I think he's probably looking at and saying spend less and then use that money to pay down in other directions. But on the flip side of this, there are a lot of wealth building strategies with permanent life insurance. I think the key to it is, in order to build wealth with a permanent life insurance policy, you need to overfund it. You need to pay into it more than what it requires. And when you start doing that, the extra money you put in has an opportunity to grow tax-free and then be accessed later tax-free. And if you pass away, you leave a tax-free estate. Buy term, invest the difference, build wealth for later. Buy a permanent insurance policy, overfund it, generate tax-free wealth in there. Sitting in the middle, just buying a whole life, paying a little bit more, may not be the way to go.